episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually going to talk about more cash flow. Where do I find my cash flow, right? And the reason I want to talk about that is that we know that an interest rate has gone up and that the margin in commercial property is eroding. And for the first time, we're actually seeing a lot more people going into the negative than the positive. So where do we find more cash flow? How do we find more cash flow? And where is it? Never before we need a strategy behind working through finding the right property for you in your commercial property journey and your portfolio. So where do we find the cash flow? Now, there's always going to be, number one, the caveat to all of this that I'm talking about, there's always going to be certain type of tenants, location, and property types that will fetch the highest price point, which is the lowest yield. Remember, there is an opposite effect, an inverse effect between yield and property price. So the higher the yield, the lower the property price. The lower the yield, the higher the property price. And that's the difference, right? So there's always going to be some properties that will always take out the highest price point and the lowest yield. So you cannot compare that and look at that in your portfolio, because if you do that, that's wrong, right? That's absolutely wrong, and you're going backwards, right? So these are properties that are potentially more like your childcare, which with really long leases, your petrol stations, your franchises with really long leases, or there is going to be medical centers, allied health tenants that are in prime locations, or there's going to be like warehouses now that are selling for 5.2% yield, even though the interest rate is now higher than that in a lease stock loan, right? So it doesn't matter what you are buying, what type of property you're buying, commercial property, but it matters that you've got to take yourself away from that. So then you can focus on looking at the cash flow. So where do you find this cash flow now in this day and age? So firstly, regional is going to deliver you more cash flow than metro. But this comes to a decision. Do you want more growth in the future, or do you want more cash flow? And this is why it's so important. Right now, if you go to regional, I'm talking large regional towns, right? We're talking, let's go the three major states in Eastern Seaboard. We're in Victoria, right? Areas in Victoria regional, and we're looking at areas like Barnsdale, Warrnambool, Bendigo, Ballarat, these larger areas. We're only seeing about a maximum 6.25, or if you're really lucky, 6.5% yield, right? So that's not huge when you're comparing that interest rates at 5.5% for commercial, and that's not high risk commercial. When you're in where you're leveraging 80% or more, you're looking at the sixes. So that's only about a 1% or sometimes less than 1% margin in that, right? So if you're in Metro Melbourne or Metro Sydney, 5.5% probably right now is probably your benchmark. If you're getting office space, it's probably a little bit higher, right? So that means that you will actually be neutral right now buying commercial property. If you go regional into your large regional areas into New South Wales, we're looking at Albury, we're looking at Wagga, Dubbo, Orange, and potentially further up the coast, like your Port Macquarie's, like a Grafton, like a Coffs Harbour. If you go up that way, what you're going to see there is more that between around a 6% is what coastal towns are tracking at, and regional inland is going to be towards that 6.5%. So still not huge, because back before COVID, these towns were doing 7.5%, and right now we're in that 6% zone. So very, very different. Now, we're also looking at if we're in regional Queensland. So really going back into regional Queensland now, actually for the first time, is actually maybe giving you a little bit more than the other regional states, maybe somewhere between 1/4% and 0.5%. In towns where you're probably going to see somewhere where you can get to a 7. In Rocky, you're probably definitely a 7 to 7.5, but the area is very, very flat. And if you want any kind of capital growth, that is not the state, that is not the suburb or the area to be in. There's areas like Mackay, like an Emerald, like potentially like your inland into your Gympie's, where and Nambour is where it should be doing about 8% because it's high risk, and it's probably doing less right now because of the demand in the market. The demand hasn't stopped in commercial property. It is actually now become more, especially between 800 to 1.2. Now, if you're in that 2 million bracket, it gets a little bit better. You're in that $5 million bracket, it gets a little bit better after that as well. So there is scope all the way. And Where do you choose? Where do you find more cash flow? Now, my biggest advice for you when you're looking at cash flow is your finances. You got to look at how you're going to do that. So if you need to buy your set and forget, it's got to be a 3 or 5 year lease, and your 3 to 5 year lease plus, that's going to give you some kind of cash flow. Now, number one thing you got to stop is the erosion of the buying power and erosion of your capital, right? And that's why you put it into property. Any kind of growth is going to sustain that, and you're going to keep your cash where it is, and you're going to keep the value of your cash, which is really important, right? So that's number one. Number two is that when you're looking for cash flow, if you're looking for set and forget, go for your set and forget properties, and potentially with your set and forget, then look whether in the next 12, 24, 36 months, whether there's anything you can tweak, right? If you went for a property that was multi-tenanted and it was a 7% and you lose a tenant, or it was it could be an 8% in the future, that is actually ideal for this property in this kind of market, right? Because losing a tenant allows you to replace a tenant at a brand new lease with a brand new negotiation, potentially even get 5% more on your rent, or even if it's like a 10% more, that's brilliant, but even 5% more, right? It doesn't seem like a lot, but all those increments start to add, right? So losing a tenant that is small enough that doesn't impact your overall cash flow is actually where you would find more cash. And then look at more creative ways of what else can you add value, right? So obviously, if you're in mezzanine, could you build a second level? Could you do the extension? Or if you are looking at strip shops, and strip shops is one of the easiest ways to do this, is where you can tweak things by maybe adding shipping containers at the back on the land, maybe extending out a property like so that there's more lettable area, creating al fresco dining areas at the front, all of those things. And certainly definitely with strip shops, based on our experience, swapping out a tenant can be one of the biggest benefits to the mix and to the actual security of your property, right? That is almost a definite, right? So then really where the cash flow is found is in the additional cash flow you can create on the property. If you look at set and forget right now, to be really secure, you can really only go up to 7%. 7% is where your secure point is. Anything above 7%, things start to add levels and levels and levels of risk. When you get to your 8%, you're actually in a much more higher risk zone based on the areas you have to be in, based on the current market trends, right? So at 7%, you are at a happy level. Now, if you can engineer anything above 7, or you can put your property on a trajectory where it is going to go above 7 in the next 2 to 3 years, that is where you're creating wealth for yourself, right? Where you're going to get more cash flow as the interest rate goes up, and you are going to create more wealth as the interest rate comes down. What happens is that the value of your property goes up, the returns goes down, because it always happens in opposite directions. That's where you start to have wealth to allow you to buy the next property, and to also give you more cash flow in the pocket as well. So those things matter, right? So when you're considering buying your first commercial property and you're searching for cash flow, what you need to look at is, don't look at it now. Whatever you buy now is never going to look good in an environment where interest rates is 5.5% and 6%. Look at where it could be in 2 to 3 years' time, where it could be in 5 years' time. Remember that property investment is a long-term game, and that where you get to in that 3 or 5 years is really going to define your wealth. And if you want to grow your wealth, look at a way where you might even have some temporary losses by losing and changing a tenant, but the trajectory, as long as you're on the right trajectory, it will always pick up, and you will always end up with more cash flow and growth, right? With your property deals, right? And if you could build in some hidden upsides, that's going to be fantastic. But look at what you can make of that property as the number one key to finding more cash flow and more growth in your property portfolio. And I know that when you look at things, when I look at things, it could be very, very different. And this is why, if you want someone to surround you with a professional team, you want someone to give you an expert eye over your properties, reach out to us, helentarrant.com, Unicorn Commercial Property. This is what we do. We help everyday Australians become wealthy through commercial property. Build your cash flow through commercial property. So in the meantime, if there's any other topics, anything specific, drop me a line. My email's below, and let's get together and talk about commercial property and how we can set you free through commercial property cash flow. So until next time, bye for now.